Roland, I'd like to thank Shares very much for giving me the opportunity to talk to this audience. Why am I here? Well, I'm on a journey. I'm trying to build a new British investment management centre of excellence. And the environment out there is quite challenging. I've done a number of things right. I think we've worked out how to manage money well, and I've acquired some good people. And we've been working together as a team now for about 13 years. But one of my difficulties is how to engage with the people who matter, and those are you. So I'm going to share a few thoughts now about how I think money should be managed if it's going to be managed well. I'm feeling particularly nervous, however, today, because in the audience is someone who played a very important part in my early career. Melanie over there was my PA about I don't know how many years ago, but then she left. And to have this lovely lady on the front row who is now working for Allianz. So the world goes round, doesn't it? Anyway, there we go. Guinness Asset Management, we've got 35 employees, of whom 12 are investment professionals. We run open-ended funds principally, both here and in the American market. We have about £1 billion under management. We're 100% employee-owned. And our strategies are long-only and focus on global equities, energy, and Asia. And just a little bit about myself. I was an engineer. In my investment career, I spent from 18 years, from 1980 to 1998, building up a business called Guinness Flight Global Asset Management, which was bought eventually by Investec. We went from 200 million to 13 billion, 20 people to 350 people. I started this new company in 2003, and I focused initially on energy investing and investing in China. And we started developing these global strategies that I want to talk about now about 7 years ago, when I'd got the people in place. And I thought there really is an opportunity here to do something exciting in business terms, and I must start producing things that people really ought to want to own rather than just what interests me, which were energy and China. That's the growth of our global strategies. It's up about from very little to nearly £500 million. They both perform very well. I'm going to flick through this incredibly quickly, but you can see that the Global Innovators Fund, that I'm going to spend most of the time talking about how we run that fund, because I want to share with you how I think you should run money well. And by the way, you don't have to buy my fund, of course. This should help you run your own portfolios, in my view. So we're the best performing fund over 10 years out of 135 in the IA global equity sector. And our global equity income is 4th out of 21 since its launch 6 years ago. And you can see our Global Innovators Fund has smashed the MSCI World Index. Someone asked about other indices. It's ahead of, by the way, of the S&P and the NASDAQ as well. And this is just the sectors it's in. And by the way, it looks over 1 year quite low, but actually this is only the top 40 of 240 companies, funds. The Global Equity Income Fund has done the same. That's since its launch against the IA sector and the MSCI World Index. It's grown its dividends and it's done well in its sectors, as I said. Sorry, that was the preamble. Now, one of the headwinds that I have to deal with is passive versus active. Do we add any value at all? Well, some of you may believe that you add value. You probably don't believe that I do. Well, anyway. And I am also here I'm in quite a sort of hostile territory here from one point of view. The AJ Bell look after you very well, but they don't regard me, or indeed Allianz, that favourably, actually. They really believe that passive is the way to go if you're going to use funds. And they have a number of passive funds, and this is their AJ Bell Adventurous Trader portfolio. And it's the most aggressive of their equity funds, and there is its performance, 6.19% per annum compound. I show its asset allocation, 40% UK, 15% US large, I think the same in Europe, emerging, Japan and Asia Pac. Now, how has Global Innovators done against that? Well, we've done rather better. So, now, of course, and that's, where the light blue line and the AJ Bell line is the bottom line. Now, this is not a go at AJ Bell, but it's to try and make a point that if you are going passive, you are left with a problem. How do you do the asset allocation? And a global fund like ours is one of the ways you do that. And I believe, by the way, that if you're going to use funds, you should go about 50% passive and 50% with global managers like us. Now, so we rattled through that. I wanted to manage money well, learning what I'd learned over whatever it was, 30-something years. And I felt that you had to try and put your canoe in the fastest flowing part of the stream. And there are various ways you could do that, but basically you start with a good investment philosophy. And we had a light bulb went off, in my head anyway, in the early part of this millennium, when we were trying to think about how to design a good growth fund. We were very interested. We had a technology fund. We were interested in technology. We were thinking about what Warren Buffett and Ben Graham and all these investors were talking about. Warren Buffett had his moat idea. And we alighted on the idea that maybe companies that have got some innovation in their DNA might be a good way to source good growth companies. And that's where this comes. It's a growth fund based on that very simple concept. And then we said we're going to buy companies that we see having a bit of innovation that are quality companies. And I'm going to talk a bit about that because I am an engineer and I believe you mustn't just use words. You've got to try and have a meaning for them. We mean something when we talk about quality. And in fact, what we mean, I'll tell you what we mean. We mean consistently high cash flow return on investment. And that is a metric we look at hugely. And then we want to have, in this particular strategy, we want to have growth, because you can have a company that's in a monopoly and has a very high return on capital but can't grow it, because its monopoly won't grow. But we want to have companies that have got growth potential, and then we want to buy stocks that we believe in. And we think this is a better growth fund. I'm just going to touch on my other global equity strategy, which I think is, I'm only going to spend 2 seconds on this. We had this idea that if you want to have a more value portfolio that is safer, less risky, but still in equities. I'm a great believer in global. I think you should diversify your assets around the world. I can't see what the point in having a UK portfolio is. We latched, a couple came up with my idea, the idea is you should have quality companies. And so in this fund, every single company is top quartile in cash flow return on investment every year for 10 years in a row. And out of 18,000 companies we started with, there are only 500 companies that make that cut. And then we look for value, and they've got to be able to grow their dividend. That actually reduces the universe to about 250 that we select from. So, good investment philosophy. I'm not going to talk any more about that fund, but I just want to explain you must start with a good philosophy. Another thing that I started doing in 2003 when I set up Guinness Asset Management was to construct portfolios intelligently. And I concluded that equal weight concentrated portfolios were the way to go. I started off with 25 stock portfolios that were equally weighted. I've ended up with 30 and 35. That's where I feel most comfortable. And we've really run that for the last 10 years. And someone says, what's the point of that? Why don't you have more in the stocks you really like? Well, there are various problems, and I'm going to tell you about the advantages of our route. So I have a 30 stock portfolio. It's got 3.3% in every holding. And after a month, I may rebalance it. And some of the funds have done, some of the stocks have done rather well, and some of the stocks have lagged a bit. And we buy more of the ones that have lagged. There's an element of buying low, selling high in this. The second thing is, fund managers are very bad And I think you're probably all in this boat, very bad at selling. And if you have 30 stock rule, it's one in, one out, mate. If when we come up with a new idea, we have to sell something, and the fund manager says, I don't know what to sell. Oh, Tim, look, I said, you've got 30 stocks, find the one you like the least. You like them all, but find the one you like the least. A 30 stock portfolio controls stock specific risk. You'll find some funds, some concentrated funds will have up to 8 or 9% in a stock, and that can be pretty painful if that blows up, because we all have stocks that do blow up. We have a high active share. We're absolutely not closet indexes. The asset allocation is driven by bottom-up considerations. But we do have a discipline. We do look at whether we've got excessive sector weights. So we have some sector weights in there. So I've got a counter on. I'm going to tell you a little bit about this fund, because obviously there's quite a lot of we empathise a lot with the technology fund and that whole idea. We think, technology has been a good place to invest in on and off. I closed the technology fund in 1990. It was the worst thing I ever did. I didn't close it, actually. He did, whoever it is. Melanie, was it you? I don't know. So we have a process that sources a universe of about 400 global companies, and some of them come from external sources, consultants who rate the innovativeness of companies, and we've got our own quantitative metrics that build them up. When we talk about innovation, and we're not just in the technology space, we like to look at business models, products and services, as well as the science and technology. So whilst we might own Intel, we might also own Walmart, who used communication technology to run an incredibly efficient, low inventory system. Netflix we regard as an innovative company, but so do we regard NVIDIA, which makes some of the chips. And we prefer to be not in the very disruptive phase. I'm a bit worried about you're in a tricky area, but you will make a lot of money if it goes well. But we think of innovative companies as starting in the disruptive phase, and then they get a period of accelerating growth. They've established their business model, and then they get a phase when growth steadies down and is happily good and nice and pleasant and continuous growth. And then just what I'm also going to share you with you, the other thing, if you're going to manage money well, I believe you need to have some disciplines. We screen a lot, and so we try and take the 400 stocks we're looking at and reduce it to 40 or 60, and we will look at quality companies that we think are cheap, where sentiment's improving. We have all sorts of different screens, and then we'll do a deep dive, and we're quite good at modelling, and then we put it onto the watch list or the list. But I won't bore you with it. You've just got to have a process, and I'm not going to spend much on this. This was just an example of some screens. I think it's not a good use of your time. We are good at modelling. And what are we looking for? We're looking for companies where they've got high cash flow return on investment. I do bang on. It's one of my mantras. That's a good way to make money. Focus on companies that have got high cash flow returns, and then you want them to be cheap. The prospect that the market will re-rate them, and we're sort of typically looking for 50% upsiders. Although one other thing I will share with you, if you're constructing your own portfolio, and the same with funds, it's quite sensible. Peter Lynch taught me this. He said you need to have a handful of stocks, not too many, that you think can be 10 baggers. It can make a hell of a difference. I talked about self-discipline and the one in, one out. We do, however, try to augment that with every month we look at the stocks that have done best over the last year, the 5 stocks that have done best and the 5 that have done worst. And those that have done worst, we say, is it because their business is deteriorating in some way? Those that have done very well, have they now gone up so much that they've moved from cheap to expensive? Is there something about their high cash flow generative characteristics that are changing? Are they now suddenly investing a lot of money and so they're changing the cash flow characteristic of the business. That would cause us to pause, and maybe just the reason we bought them turned out to be wrong. We thought they were good at something and they weren't. That's my mantra. One other thing on this, so 30 equally weighted holdings, diversified globally, some limits on sector and industry. And I didn't touch on low turnover. We greatly believe in buy and hold. 3 to 5. We're not good at trading. Some of you may be good at trading. That's fine. If you're good at that, by all means, you can do something I know do very well. And assess over concentration. And here I thought I'd share with you our current portfolio. What we end up with is quite a few companies that are here in the technology area, and some of them must be in the same area that you live, but not all. And we have some healthcare, Danaher and Gilead and Shire, and we have some people might not think that Nike was innovative. We think they are. I mean, it's just Fanuc. We've recently bought. I've been watching Fanuc for years. They're the best robotics company around. They've always been too expensive. We just snuck them in there. And by the way, our approach. This is a growth. This is a growth thing. But we've managed to get the PE. Really pretty, we're not paying 25 times earnings. We're paying high teens. That's that, and so we're now, how do we see this? The bulk of our fund are growing their business at 10 to 20% growth. Someone might have asked this. The market cap, our lowest market cap is Wisdomtree. Now, why are they innovative? Well, they're in the ETF space. That's a game changer, frankly. They're a new entrant. Very high return on capital, very interesting. And Alphabet are our largest. So we go from 1.6 billion to 500. I can't see it now, but it's somewhere there. 556 million. So I was just looking at the bulk are in this 20% growth, and then we got PayPal and a Chinese educational stock, 20% plus, and then you've got sort of 5 to 10% growth up there, and I talked about low turnover. And I'm a great believer you've got to hold people's feet to the fire, and you can see here that we've bought 7 stocks. If we got 30 stocks, which we have, and we had a 5-year hold period, we would sell 6 and buy 6 each year. So we sell 7, 6, 5, 7, 1, 2. We do what we say we do. Sector allocation, there's that quite big IT chunk, but no materials, no telcos, no utilities. They don't have a high enough return on capital. Quite a big weighting to the US, but we have here just been reducing our US exposure now. But it is bottom-up driven. Are we doing what we say we do? R&D to sales, 8% against the MSCI World, 5%, and CapEx to sales. So these are low CapEx light, 6% against 9% for the MSCI World. The return on capital, 18% in 2016. That's cash flow return on investment, CFROI, against 11% for the world. Net debt to equity, we are net cash. MSCI World, 71%. So things like that. What else we got over here? Do we keep them equally weighted? Yes. The top 10% of our fund is 33% of the fund. We've got 30 positions. And that was, I was now moving on to the global equity income bit. And I have got the pack I brought with me. I'm rather pleased with myself at the moment. The pack I brought with me had 60 slides. And you will get that. It's on a table out there. But there's another set of slides that cover global equity income. But I wasn't going to bore you with that. But I circle back. I think good investment management is trying to have a good philosophy and then follow it up with good people, good process, good disciplines. And I like to think that we're doing that. And so, yes, you can put some of your money into the A.J. Bell Adventurous, but you can put some of it into our global funds. I think I'm pretty wrap up and begin question time is what this notice says.
Thank you very much. Do you have any questions?
Yes, other fund managers like Schroders and Henderson offer very similar products. How are you different from them?
Well, first of all, we're different people, but better. we're more disciplined, more intelligent. No, sorry, but it is true. Of my 10 fund managers, 8 went to Oxford and Cambridge, and a majority are physicists and engineers. I think that, of course, there are many ways of managing money well, actually, almost as many as there are fund managers. But I think that what I believe we do is we've worked out a way of doing it, and we just do it. And I think we do it more than some of the others. And something else is different from us. We are still at that boutique stage of our life when our team owns the business. And basically, they get rich if we make a lot of money for our investors, because then we get rich, because the fund becomes more valuable. I mean, we'll attract more investors. Whereas if you work for Schroders, yes, you'll get a large bonus and all that sort of thing, but it's not quite the same. There are very good people in Schroders, by the way. Anyone here?
Yes, please.
Tim, you made a very eloquent announcement on how we should manage our portfolios, but as private investors, of course, the one other thing that you haven't mentioned was tax. And I know you do some EIS and I think IHT funds, and do you apply the same investment philosophy to those? And I don't think you do a VCT. I think that you...
Not yet. Not yet. No. Yes and no. They are we're so pleased with our EIS business. It's come from nothing to I don't know, 75 million in 4 years. Very good team of people. But as you know, I can't remember if I mentioned that I ran energy. Energy was one of my interests, and our EIS business has actually been very much focused on building on the twin themes of we know about renewable energy, and we saw an opportunity with the sort of feed-in tariffs and EIS ability of that sector to build good special purpose vehicles in that sector. So different, actually. I think we did that well, but you can't. It's not really comparable to this. We've got an AIM fund, which has some comparability to it, but you know, it is a different world, the tax-based investing. Tax is, of course, important, but lots of people now have their money in ISAs and SIPs. And of course, that is a reason that's a tax sheltered environment, and that's and you know A.J. Bell as one of the most successful,
probably the
leading is why again why have I come? I've been trying. I said to myself, I must find out who are these people who use A.J. Bell or bits of A.J. Bell. So I'm here to find out about you. Who are you?
Any other questions, please, gentleman here?
Tim, you inferred that you might be getting into VCTs at some stage. You'll have gone almost full circle then, wouldn't you? Because I think you and Howard Flight actually set up Guinness Flight VCT.
We did.
In the dim and distant past, which has been, after many incarnations, I think it's now managed by Maven. It wasn't the top performing VCT of its cohort.
Yep, you're quite right.
So
I'm going to bite my lip. It wasn't. It didn't come directly under me, Gov.
So it was all Howard's fault.
I'm not going to say a word. I'm not going to say a word.
And just as a thought, I think, on you talked about starting with a good philosophy, and I think we had a chap talking with VCTs, Guy Miles, who's one of the co-founders of Octopus, at one of our conferences in the summer, talking about global exposure and how many of our customers at AJ Bell, readers of our magazines, are so heavily weighted and focused on the UK portfolio and the dangers of that. And I think we've seen now with currency risk, with Brexit, with Trump, how important it is perhaps to have a more global approach, whether that be through direct equity investing or through using funds or other vehicles to support your single equity investments. And I think that's something I think as a philosophy, I think we would very much support. Slight digression. Any questions? Gentleman at the back here, the jumper.
Hi, I'm on the same theme about VCTs and EIS. Where do you see the differences now between investing in EIS compared to VCT with the restrictions now on VCT investment and the changes in the last couple of years?
Yes. Am I the best person to answer this? There is. I'm not going to give you a terribly good answer, but I know that the lock-in period for VCTs, I think, is 5 years, and the EIS is 3.
I'm not sure.
Yeah. No, I do get them to explain it to me. And it just goes in one head here.
Going back to your EIS answer earlier about the feed-in tariff, these days are over, obviously.
Yeah.
What are you moving on to in terms of your EISs now? You sort of changed direction, strategy?
Yes, we have, I think, concluded that we are quite good at what I call project management. We can get things done really quite efficiently, and we are putting together a portfolio of what I would call lowish risk companies doing things that have got something backing them. I'm going to say property assets, but they're not necessarily pubs, but it is things that have got long-term contracts backing what they're doing. Cemeteries, I don't know. There are, anyway, we've got a diversified portfolio of 10 businesses. It'd be better if they were here to talk to that. But they've made a very good pitch to me, and I'm going to shelter something I've got with it.
And I'm just coming back to the one, if I may, on the filtering process.
Yep.
You talked us through. You talked about how you have these different screens to filter down the universe of companies that you might invest in. Do you also go and see them? Do you work purely from the data, or do you go out and meet management?
You're not going to like what I'm about to say, I fear, although you may. It depends how reasonable you are. We don't believe in meeting company management. In fact, we think it's dangerous. I latched onto this 20 years ago, you know, and I met a Belgian fund manager, and he said to me, "We never see management." Oh, I said, "Good Lord, are you going to bowl me over?" And he said, "Whenever we go to see management, you know, they impress us. They may impress us hugely, and they sound so dynamic and energetic. Look at this speaker here, or I remember I went to see a Chinese company. I went to see Sinopec, and I promise you. Oh no, was it Sinopec? No. I talked to you. It wasn't Chinese. It was a Russian company. I think it was Lukoil. And the management was Stalinist. They didn't understand shareholder value. I said, well, we can't invest in that. And just before that, I'd seen another manager who was incredibly, in fact, a company called Weatherford. I don't know if you know it. They were a very successful oil and gas service industry company, run by a very charismatic Frenchman. Oh, I thought, God, Charles, he's got a bloody good, he's really done well. He's grown his market share. If we just have a little bit in there. I had allowed myself to get carried away by how ghastly these Russians were and how wonderful this other chap was. And in fact, I should have looked more at the numbers. And I believe that you look at the numbers. Now, of course we do meet management a bit. We find it a useful source of information. I always try, if I can, have enough time with management, actually to talk to them about their competitors too. Because I find they're a very useful source of information about the competition, more than about themselves, frankly. Also, what I'm saying to you is truer of the billion market cap and above company than it is for this company. I mean, no, we wouldn't have first of all, the numbers are hard to get by. The smaller the company, the more you do need to see the management. But does that answer your question?
That was my question, but yes.
I haven't asked my question yet.
Oh, sorry. That was your question.
It's something along similar lines. You say you have 33 stocks or 30 stocks.
Yeah.
Why don't you have one really small idea that will give you the 10-bagger? Because I can't see how you're going to get a 10-bagger if your smallest company is 1.6 billion and your biggest company is 127 billion. They're not going to grow by tenfold, are they?
No. And you're a very wise man. And when I ran my energy fund with this 30 stock equally weighted rule, and in 2003, a little company, a titchy company, comes over my horizon, and can I come and see you, Tim? How big are you? You're too small. It was the broker actually. I could hear him sort of weep. Okay, I liked him. I said, yeah, bring them along. So I knew it was doing him a favour, and it was a very interesting story. And I thought the company was very cheap, and they told me a lot about their competitors. In fact, their customers were the large companies. I thought, we'll have a new idea. And so I took one position of my equally weighted portfolio, and I divided that into 10 0.3% holdings, or 0.33. And that was my little research portfolio, and you can call it research, you can call it nursery, whatever you like, incubator. But that is something that I do think has merit. We are actually not doing it in Global Innovators at the moment. Maybe we will. We're comfortable with it. What?
It's the only way you're going to set yourself apart.
It might be. I mean, we have got. I didn't talk about the numbers, but the adventurous strategy, doubled and we trebled over 10 years. That makes quite a big difference. I promise you, you will get a better funeral as a result. And I do want to share with you something else, which I'm not sure what AJ Bell or you think about this, but I think you're probably okay because you call yourself shares. When I go to sort of intermediaries and financial advisors, financial planners, and they have, conservative, balanced, aggressive, and the conservative has sort of 70% cash and bonds or something and 30% equities, and you go up and the aggressive has 70% equities and 30% bonds. I think, if I was in that business, I would say low volatility, middle volatility, high volatility, but I'd put on top of the low volatility, high risk. And I'd put on top of the high volatility, low risk. Because my biggest risk, in my view, is not being able to pay my nursing home fees in 25 years' time. And I'd much rather have this than this. So there you are. So I'm a great believer in real assets, equities mainly, but obviously property, private equity can all play their part. And I don't believe in hedge funds and things like that. Anyway, I think I'm holding you up from your drinks, aren't I? Time up, it says.
It says it does.
Overtime by 3 minutes.
Tim, thank you very much indeed. Thank you.